Hey, hi everyone. Um, okay, let's just give a couple more minutes to let more people join our webinar session, and then we will quickly get started. So, yeah, we'll probably start in a couple of minutes' time. So, in the meantime, you can grab yourselves a drink, get yourselves comfortable, and I will see you guys in a couple of minutes. Okay, hi everyone. I think as more people are streaming in, we will just give a couple more minutes to let more people join our session, and then we can quickly get started. But in the meantime, grab yourselves a drink, make yourselves comfortable, and then I'll see you guys in a couple more minutes. In the meantime, do let me know if you can hear me, and just to check whether the comment section as well as the chat or the Q&A section is working. So I'll be monitoring those pretty closely throughout our webinar. Yeah, so if you have any questions throughout the webinar, feel free to let me know in the chat. Hi, Wayne. Good morning. Okay, that's good that you can hear me. I hope everyone else can hear me as well. But if not, do let me know in the chat. Yeah, we'll just wait a couple more minutes to let more people join. Oh, I'm also curious to know where everybody is from, since Wayne said good morning, because over here in Sydney, it's currently in the evening. Hi, Jojo. Good afternoon. From the Philippines. That's cool. Okay, I think we can get started. Okay. So hi everyone, welcome to today's webinar. So today we're going to be talking about pivot point trading strategies. We have 5 altogether, so we're going to be going through each one. Today's session might feel a bit heavy, but if you have any questions throughout the webinar, feel free to let me know in the comments or in the Q&A section. Okay, let's begin. So here's our agenda for today and what you can expect for today's session. So firstly, we're going to be introducing what exactly are pivot points and the steps taken for using them when you're trading. Secondly, we're going to be looking at the different types of pivot points, as I mentioned earlier. After that, we're going to be looking at the different types of timeframes that you can use for pivot points, depending on your trading strategy. And then lastly, we're going to be looking at how you can add them into your trading strategy. Okay, so first things first, as usual, a disclaimer. The information which is expressed in this presentation and on the following slides are solely those of the presenter and not necessarily those of Vantage, and are solely used for educational purposes, as they do not constitute investment advice and/or consultation on how a client should trade. So Vantage does not guarantee the accuracy or reliability of the information provided herein. Trading margin FX carries significant risk and it's not suitable for all investors. So make sure you do your due diligence before trading your own money. Okay, let's move on. So here's our team. We have Desmond, who is our CEO of the company Everest Fortune Group, finalist for Best FX Research, and finalist for Best Equity Research as well in 2019, 2020, and 2021. And I'm Melanie, and I'm going to be your host for today. So today is my first time doing a webinar to such a large audience. So let me know if I can improve anything and bear with me for this 1 hour. Okay, so let's get started. So what exactly is pivot point trading? So pivot point is the level at which the market direction changes for the day. So we make use of some calculations, so some simple arithmetic, and as well as the previous day's high, low, as well as the close, and a series of different points are derived from that calculation. So these specific points can then be used as critical support and resistance levels. So the pivot level is calculated from the support and resistance levels, and that is known as the pivot level. So this pivot point trading is actually a pretty popular trading strategy because it is predictive instead of lagging, because it uses information from the previous day to calculate potential turning points. So here are the basic steps for implementing a pivot point trading strategy. So firstly, we calculate the pivot point. So the pivot point is calculated as the average of the previous day's high, low, and close prices. So this is the most important level because it represents the point at which the market may change direction. So secondly, you then calculate support and resistance levels. So once the pivot point is determined, you can calculate the support and resistance levels, which are based on the pivot point and the previous day's price action. So I've included a couple of bullet points on how to calculate, but this is just if you want to do your own calculation. If you're using TradingView, most of the time it's already calculated for you. But we'll just briefly go through it for those who want to do your own calculation. So the first support level is calculated as twice the pivot point minus the previous day's high. The first resistance level, so the level that's above where price currently is calculated as 2 times the pivot point minus the previous day's low. And then the second, support and resistance levels, so your S2 and your R2, would then be calculated by adding or subtracting the difference between the previous day's high and low to or from the pivot point. So lastly, you calculate the pivot point. Sorry, I think my slide is wrong. Okay, so ignore the slide and just listen to what I'm gonna tell you. So lastly, we want to use the levels that we've calculated in the previous slide. So let me just go back. So from the levels that we've calculated in step 2, the third step would then be to use these levels as entry and exit points. So once the support and resistance levels are calculated, you can use them as your entry or your stop loss or your take profit levels. So for example, if the market is approaching a support level, you may consider buying. And if it is approaching a resistance level, you can then consider selling. Okay. So let's move on to the different types of pivot point strategies. I've included the main differences between each of them, but we'll also go through in depth the pros and cons of the different strategies in the next few slides. So firstly, we have the standard pivot point. So this method involves using a simple calculation to determine the pivot point. So that would be the average of the high, low, and closing prices from the previous trading session. So the support and resistance levels are then calculated based on the pivot point. Secondly, we have the Woody pivot point. So this method uses a similar calculation to the standard pivot point method, but with a different weighting of the high and low, as well as the closing prices. So the support and resistance levels are then calculated based on the pivot point, with additional levels of support and resistance added based on the difference between the pivot point, the high, low, and closing prices. So that's what makes it different from our standard pivot point. Okay, thirdly, we have the Camarilla pivot point. So this method is based on a pretty complex calculation that I didn't include here, but it involves using multiple levels of support and resistance. So the formula for calculating a Camarilla pivot point includes 4 support levels, 4 resistance levels, and the pivot point itself. Okay, next we have the Fibonacci pivot point. So this method uses the Fibonacci retracements tool to determine the pivot point as well as the support and resistance levels. So the pivot point is calculated by taking the average of the high and low and closing prices as usual, and then adding or subtracting a Fibonacci retracement level from the pivot point to then determine the support and resistance levels. So in this case, we make use of the Fibonacci retracement tool, hence the name Fibonacci pivot point. Okay, so lastly, we have the DeMark pivot point. So this method is actually the most common amongst institutional investors. So it uses a series of complex calculations. Once again, I didn't bother to include it here, but it takes into account the relationship between the previous trading session's high and low and closing prices, as well as the current trading session's open price. Okay, so in summary, the main difference between the various pivot point trading methods would be the formulas used to calculate the pivot points, as well as the number and placement of support and resistance levels. Traders may also choose to use different methods based on their personal preferences, as well as the specific characteristics of the market that they are trading. So each of these serves a different purpose and is highly circumstantial based on the market that you're looking at. Okay, let's go in depth on the pros and cons of each of the different types of pivot points. So firstly, we have the most common, which would be the standard pivot point. So this is easy to calculate as well as understand. It also provides a good overall picture of the support and resistance levels. However, it may not work well in volatile markets, and it doesn't take into account the opening price, which may be significant in some markets. It's also less accurate than other methods. Okay. Okay. So next we have the Woody pivot point. So this is more popular for short-term traders, so like day traders. So this uses current period's opening price, and it also provides more weight to recent price movements instead of long-term price movements. So what are the cons? It's less used compared to the other methods, less effective for long-term trading, as we mentioned earlier, and it may not work well in markets with low liquidity as well. Camarilla pivot point. Pros, it's common against day traders once again. It also provides more support and resistance levels compared to the other methods, and it's also good to identify potential breakouts. But as we mentioned earlier, the calculation is pretty complex and it's not as easy to understand as the standard pivot point. Once again, may not work well in markets with low liquidity, and it may require more frequent adjustments to your support and resistance levels as compared to the other methods. Okay, so next we have the Fibonacci pivot point. So this is effective in trending markets. And of course, you can also use the Fibonacci tools as well that we've gone through in previous webinars, such as the Fibonacci projection, your Fibonacci extension, as well as your Fibonacci expansion. So all of that can be used in conjunction with this so that you get confluence as well. However, it might not work well in volatile markets or in markets with low liquidity, and it can also be less accurate than other methods depending on the market conditions. So most of these methods is, like I mentioned earlier, it's highly dependent on your market conditions and whatever the currency that you are looking at the current point in time is. So we have the DeMark pivot point, popular amongst institutional traders. It can be used to identify potential trend reversals, and it also provides multiple levels of support and resistance. Cons, difficult to calculate and understand, may require more frequent adjustments compared to other methods, and it may not work as well in markets with low liquidity. Okay, let me just check the chat to see if we have any questions before I move on. Oh, hi, Tokozo. I hope I'm pronouncing your name right. I didn't see your chat, didn't see your message earlier. Good day to you as well. Okay. Okay, no questions. Let's move on. So now we're going to take a look at the different time frames that you can use for pivot point strategies. So here's an example of a pretty unclear market structure. So this is on the M15 view. We're just going to go through a brief recap on what to look out for on the different timeframes before we zoom in to pivot point specific timeframes. So here's just a general chart with an unclear market structure. This is on an M15 view. Here we have a clearer market structure. You can see I have drawn out the shape of the market structure that you can look out for. And this is the same chart, but on an H1 view. So what we're trying to show you from this is that before starting any analysis, you want to first make sure that your the chart that you are analyzing has a clear market structure. And you can do this by the easiest way would be to adjust the time frames. So you can see on the 15-minute, it's unclear, but on the same chart, on an H1, it's clearer. So then you can begin your analysis on the H1 instead of the M15. And typically, we also would not recommend analyzing on M15, M30 time charts because those tend to have more noise. So typically we use H1, H4, or the daily time frames. Okay. So the very basics, the clearer the swing low, clearer the swing high, the clearer the trend between the 2 points, then your it shouldn't be Fibonacci retracement, but in general, whatever you are analyzing, it will be more accurate. Okay, so for specific pivot point strategy, the time frame formula that we like to use would be intraday. So either H4, which would be the weekly setting for the pivot point strategy, or the daily, which would be monthly. Okay, let me just pull up my trading view so I can show you guys what I mean. Okay. Okay, so here I have my gold chart here. So before we analyze, we typically will look at the monthly, weekly timeframes as well, the longer timeframes, just to see where prices, the general direction of where prices are headed to. So this is on the monthly, you can see prices are rising, and on the weekly. And then now let's take a look at the daily. So if you guys use TradingView, okay, if you guys use TradingView, you can just pull out the pivot point indicator over here. And you can see there are a whole bunch of pivot point indicators available for you to use, but we've tested a couple and we've come to the realization that pivot point standard is the most accurate to use. Okay, so if you go to the gear or the settings indicator, here we have the type. So under type, we have those that we went through earlier, traditional, which would be the standard that I mentioned in the slides, followed by the Fibonacci, Woody, Classic, DM, and the Camarilla. And these are the support and resistance levels that we typically use, as well as the pivot level. So S1, S2 would be the supports, R1, R2 would be the resistance levels. What we want to look at now would be the pivots time frame. So as you can see now, I'm on a daily time frame for my chart. So my pivots, as you mentioned earlier, on your pivots time frame, we would use monthly. So as you can see here, it's pretty messy because my pivots time frame is on a daily. But you can see once I've adjusted it to monthly, it's a lot more effective and a lot easier for me to use because it's way less messy compared to earlier. Okay, now let's see on, let me hide this first. So as I mentioned earlier, before we start analyzing, we want to see that there is a clear trend in a clear price movement. So this is on the daily, this is on the 4-hour chart. So you can see it's not as clear in market structure compared to our daily time frame. And here's the 1 hour as well. Also not as clear in market structure. Like there's no clear movement in price. That's what we're trying to say. So let's go on back to daily. But I want to show you what it looks like on the 4 hours as well. So 4 hours, as we mentioned earlier, we want to use the weekly time frame. So same thing, I'm gonna go to my gears. And here we have the weekly. Earlier, when it was set to monthly, you can see the time frame is pretty long. So that's the reason why we choose weekly. So you can see here, this change in pivot is when the market opens, and that's our starting point here for the day at the pivot point, at the new pivot point. So this was on the 27th, and then this was on the 20th. Since we're on a weekly time frame for our pivots. So it's exactly 7 days. Okay, let me clear my... Okay. So I'm going to go ahead and use the daily time frame instead. Okay, so now let's introduce something known as the Fibonacci confluence, or rather the pivot point confluence. So if you've been with us for a couple of webinars now, you would know what a Fibonacci confluence is. And in this case, the pivot point confluence is kind of the same thing. So confluence is basically when you have a lot of levels, either support or resistance levels, that line up nicely with each other. So I'm just gonna... So here I'm using Fibonacci for my first one. So next we want to use the Woody. DM. And then lastly, we have the Camarilla. Okay, so it's a little bit messy now. Let me just clean it up. So now I have two pivot points that we can look at. So confluence would be when you see multiple levels that line up at the same point. And you can see somewhere like over here, where there is a lot of confluence, that's where price tends to reverse off of. Here. So that's a way easier way to predict where prices would reverse off. Okay, so now I only have two different methods of pivot points. Now let's have another one. So it definitely doesn't always work. So you need to do this together with your support and resistance levels. So that would be your graphical analysis. So trend lines, trend channels, all of that are still relevant. So once you've done that and you've identified where the general trend or the general direction of where markets are heading, once you've covered that, then you can pull out your pivot point methods, find a point where there is confluence. So it's like somewhere over here, or like over here, you can see. Price reversed off of this and then it went back up. So something like that, once you've done your graphical analysis, then you make use of the different indicators. So something like you can use your pivot point indicators, or you could use Ichimoku, MACD, whatever you're comfortable with. And then in order to make your analysis more accurate. But what I'm just showing you over here is how to find confluence in order to predict a breakout, either a breakout or a reversal. So like you can see over here, there are multiple levels, multiple support levels over here, and you can see price reversed off at this level. It might be too messy if you had all 5 like this. So you can start off with one first, and then slowly once you've identified certain levels, then you can unhide those and find more. Okay, so let's take a look at another chart. This is gold. Let's take a look at pound. I'm curious to know what other indicators you guys use. Do you guys also make use of the pivot point trading strategies or the indicators, or what other indicators do you guys use? Let me know in the chat. Okay, in the meantime, let's go ahead and analyze the pound. So same thing, we start off by looking at the monthly time frame. We start off at looking at a longer time frame so we know where prices are heading. You can see the pound dropped. We look at weekly. You can see a swing low support over here. Here's the 4 hours. On the 4 hours compared to the daily, you can see a much clearer movement in price. So here's the 1 hour. Okay. So we mentioned earlier that we would typically stay away from the shorter time frames. So 5-minute, 15-minute, as well as 30-minute. So let me show you why. Let's start with 5-minute. You can see on our 5-minute time frame, there isn't too much, there isn't a clear movement in market structure. You can see it's kind of unclear. So this is kind of what you want to stay away from. If we look at 15-minute, there's also a lot of noise on the lower time frames, because prices, you can see the candlesticks every 15 minutes as well. So there tends to be more noise on the lower time frames. So that's why we will stick to 1 hour, 4 hour, or daily to do our analysis. Okay, let's go with daily in this case. Okay, Rajat asked which strategy is good for intraday trading. So let's go back to the slides. just so I can show you the pros and cons. The first few that we went through, those are really good for intraday trading. So like the Woody as well as the Camarilla for intraday trading. But typically for pivot point strategies, most of the strategies can be used for intraday. Okay, Tokozo says he normally uses MACD and EMA. I also normally use MACD as well because it's so easy to use. Okay, let's go back. Okay, so I think we can all agree that pound is on an uptrend. Okay, this is not a valid trend line because for a valid trend line, we need 3 significant touches, and in this case, it's not quite touching. Let's see if I have a trend channel. So we start off by looking at start with the graphical analysis first. Okay, no trend line either, but we can all agree that it is on an uptrend. So once we've identified the trend, then you can identify your support and resistance levels. So here's a support level. This would be the closest to where current price is. It is also an overlap support level because we have a swing high as well as 2 swing lows. And here is our swing high resistance. Okay, so now let's pull out my pivot point indicator and see if we have any other levels. Okay, let me zoom in. So here you can see the R2 and I have an R1 that line up nicely at where my first resistance is. Let me just check the chat really quickly. So sorry about that. Okay. So here I have my one resistance level that lines up with another resistance level, and this is my first resistance that I identified earlier. This is my first support level that I identified earlier. However, I can see that my first support level doesn't line up with any of the pivot points or support and resistance levels that we've used for the indicator. So let's see if we can find any other levels that are more significant. Okay, in this case, I want to pull it back further. Once I've pulled it back further, I can see that my R1 and R2 are also pretty close to this level. So that's why whenever you are identifying support and resistance levels, it's always recommended to pull it back as far as you can. Cutting the wicks of candles is all right, but you want to try not to cut through too many candlesticks or the bodies of the candlesticks. Okay. So if I pull it back here, then I can see that there are multiple resistance levels that line up with this support level here. Okay. So now that I have one pivot strategy, I can go ahead and pull out another one. Okay, let's go with Fibonacci. Okay, once again, you see a couple more levels lining up with my first resistance as well as my first support. Over here, you can see a pretty big confluence area as well, with all of the support levels lining up. And it also lines up with multiple swing highs. You can see here, we have one swing low. Sorry, swing low, I mean. We have one swing low, two swing low, and three swing lows. Okay, so that's what you want to look out for when you're identifying significant support and resistance levels, because those tend to have, when you have a confluence area, there's a higher probability that price might reverse off of it. Okay, so risk management for pivotal points. So typically for risk management, when you trade, you won't exactly trade at this first resistance, first support. These levels are just important for looking out for reversals or when price bounces off these levels. So when you actually trade and you go in for your entry and you're deciding for where to put your stop loss or your take profit, let me just show you a chart. Okay, I think it's here. So you can go on to the forexarmy.com. It gives you an in-depth technical analysis checklist. And I think somewhere here we talk about trade management. Let me just look for that. Sorry, my Wi-Fi is a little bit laggy today. Okay. Let me just show you on this chart to not waste time waiting for that. So if you're looking for a stop loss, sorry, let me just pull out, see if I can find the chart to show you guys for risk management. Okay, I can't pull it out now because my Wi-Fi is really, really slow today. So sorry about that. But I'm just gonna try and explain it on this chart first. So we have, let's say we have our stop loss over here. And my take profit perhaps over here. And this swing high resistance in line with multiple resistance levels as well. Okay, let me just label this take profit. Okay. So the general rule of thumb is your stop loss should always be placed beyond a confluence level. Okay, let me just show you what I mean. Stop loss beyond. Okay. And then our take profit, on the other hand, should be placed before a confluence level. So as we mentioned earlier, we have a confluence of resistance levels over here, right? So typically our take profit, we want to put it before this confluence level. So this is my first resistance. My take profit will probably be somewhere before. So further down here, this would be my take profit. Okay, and then for stop loss, you would want to have your stop loss beyond the confluence area. So once again, my confluence area is here. Okay, at my first support, my stop loss would be beyond it. So the reason for this is because price is attracted to strong areas of confluence, be it pivot point confluence that we're talking about now, or Fibonacci confluence. So if your stop loss is right before instead of beyond it, there's a higher probability that you will get stopped out before market reverses. So like somewhere over here, price is likely to reverse off of it and you might get stopped out if you are over here. Okay? Okay, but if we're talking about take profit, then when price reaches this confluence area, there's a high chance that it will not go beyond it. So you want to make sure that you put your take profit before your first resistance. So or before your confluence area or resistance area. So that's one of the reasons why people complain that the market may be manipulated, because they could miss their take profit by 1 pip, since price is likely to reverse off of the strong confluence area. Okay, I hope that makes sense. Good question. Let me know if you have any other questions as well. Okay, if there are more than 2 pivot points lining up at a higher time frame, such as HF, but you want to enter at a lower time frame like 15 minutes, and you find out that nothing is lining up there, can you enter your trade still? Mm, find out that nothing is lining up at your 15 minute, but you want to enter. Sorry, give me some time to understand your question. Lining up at a higher time frame, but you want to enter at a lower time frame. Enter at 15 minutes. You could, but then you would just have to wait a longer period for your trade to follow through, because if you are entering on a 15 minute, there's definitely more noise compared to a 4-hour time frame. So you would have to wait for your trade to reach the point on your 4-hour time frame, if you understand where I'm coming from. Okay, I hope that makes sense. Okay, but good questions. Let me see if we have any other questions. Okay, no other questions. If not, let's look at one more chart together. Let's look at WTI. Okay. Okay, so same thing before we start any analysis, we look at the larger time frames. Okay, let's start with weekly. Weekly, you can see price testing this level here. Okay, on a daily, okay, here's the daily time frame. You can see price continuing in a downtrend. Here's the 4-hour chart. And here's the 1-hour chart. Okay, I think we can all agree that the daily time frame has a much clearer price movement. Okay, so let's start analyzing on our 1-hour time frame. Okay, firstly, we identify or we do graphical analysis first. Okay. So we look to see if we have any descending trend lines or descending trend channels, which in this case, okay, I don't think we do, but we can all agree that prices seem to be dropping. That's the general trend at least. So now let's go in and look for support and resistance levels. So here we have the closest swing low to where price currently is. Okay, here. Okay, so sorry. Here we have the support and resistance levels to where price closest to where price is. Now let's pull out our indicators. Okay, since we are analyzing on our daily time frame, we're gonna adjust this to be monthly. Let's do the classic first. Cool. Okay, so you can see my R1 for the day lines up exactly where I put my first resistance. In this case, my support level doesn't line up, but that's fine. Let's go ahead and look for more confluence levels so we can adjust accordingly. Okay, we can see that where price currently is at, this is a pretty significant support level as well. We have 3 swing lows, and we can also see that there are many support levels that line up at all of these swing lows. So this is a high level of confluence. But if we take a look here, this is a significant swing low, 3 significant swing lows, so this makes it a pullback support level. But now price is currently testing this level. So since there's such a high level of confluence, price may reverse off of this level and hit back down to where our 66.028 level is. So that's how you make use of the confluence areas basically. Okay, let me just check to see if we have any questions since we have 3 minutes left. Okay. Okay. Is it wise to enter at a higher time frame like H4? I thought smaller time frames provide much better entry points with better risk reward ratio, more especially if you are an intraday trader or scalping. Um, I guess that would depend on your trading strategy. Everything that I've gone through today is just what we do for a general pivot point trading strategy. But if you are more of if you're more into scalping, I think that would be slightly different. Is it wise to enter a higher time frame? Well, yeah, it depends on your strategy, I suppose. Because if you enter at a smaller time frame, as we mentioned earlier, um, let me remove everything to show you. If you take a look here, okay, I guess you could adjust your pivot point time frame as well accordingly if you were to use a 15-minute time frame. Yeah, so it depends on your strategy. Okay, do we have any other last minute questions? No problem. Okay, if not, that's all I have for you guys today. Thank you guys so much for joining me for this webinar. I hope you guys learned something or found it helpful. Yep, and I will see you guys next week. Have a great rest of your week and stay safe. See you guys. Bye, everyone. Bye, Tokozo.